Have you ever wondered what the stock market is all about? Well, buckle up because we're about to break it down for you. The stock market is like a big old marketplace where companies can sell little pieces of their ownership called shares to raise money for their business, and investors can buy and sell those shares on a public exchange in the hopes of making some moolah. But wait, there's more. The stock market is not just a playground for businesses and investors. It actually plays a crucial role in our global economy. It's a hub where companies can access the capital they need to grow and expand, and investors can earn a return on their investment by buying shares of those companies. So, how does the stock market work exactly? What drives its movements? And most importantly, how can you get in on the action? Don't worry, we'll cover all of that in this video. So stay tuned till the end. Imagine the stock market like a big virtual marketplace where people can buy and sell little pieces of ownership or shares of publicly traded companies. It's like a massive game of trading cards, except instead of Pikachu and Charizard, you're dealing with stocks and shares. But why do companies sell these shares in the first place? Well, they do it to raise capital. See, if a company needs a ton of money to expand their business, they can't just walk into a bank and ask for a loan. That's where the stock market comes in handy. By selling shares of their ownership, the company can raise the funds they need to grow and thrive. And who buys these shares? Investors. People like you and me who are looking to put their money to work and potentially earn a return on investment. The investors who buy these shares become part owners of the company, which means they get to have a say in the company's decisions and the direction it takes. Now, there are a bunch of different stock markets around the world, but the two big players are the New York Stock Exchange, NYSE, and the NASDAQ. The NYSE is like the granddaddy of them all, founded way back in 1817, while the NASDAQ is a little younger, founded in 1971. The NYSE is known for listing big, established companies, while the NASDAQ is the go-to for technology-focused companies like Apple and Amazon. The stock market operates based on the principles of supply and demand. When a company issues shares, it sets a price based on its perceived value. So let's say a company wants to raise some serious cash to take their business to the next level. They could go to the bank and ask for a loan, but they'd have to pay it back with interest. Or they could sell shares of their ownership in the company to the public through an initial public offering, IPO. That way they get the money they need without having to pay interest or debt. Investors who are interested in buying those shares can place orders with their brokers, who are basically like middlemen between the investors and the stock exchange. The brokers execute the trades on the exchange, which is like a big virtual marketplace for stocks and shares. The price of a stock is determined by the forces of supply and demand. If a company is doing well and people think it's a good investment, more people will want to buy its shares. That drives up the demand and the price of the stock. On the other hand, if a company is struggling or something bad happens, like a scandal or a global crisis, people might start selling their shares. That increases the supply of the stock and can lead to a drop in the price. Now, there are two types of stock markets: primary markets and secondary markets. The primary market is where companies issue new shares of their ownership to the public through an IPO. The secondary market is where investors buy and sell shares of publicly traded companies after they have been issued in the primary market. So once a company has gone through an IPO and is listed on a stock exchange, anyone can buy or sell their shares on the secondary market. Stock prices can fluctuate for a bunch of different reasons. Positive news, like a company's earnings exceeding expectations or a new product launch, can lead to an increase in demand and the stock price. On the flip side, negative news, like a data breach or a CEO scandal, can cause investors to panic and sell their shares, which can lead to a drop in the stock price. The stock market is influenced by various factors, with company performance being one of the most significant drivers of stock prices. When you're considering buying stocks in a company, one of the most critical factors to look at is the company's financial health. Are they making money? Are their earnings growing over time? Are they investing in new products and services to expand their reach and improve their competitive position? If the answer to these questions is yes, investors are likely to be more interested in buying shares of the company, driving up the stock price. On the other hand, if a company is struggling with declining sales or mounting debts, investors may be less interested in buying shares, which can cause the stock price to fall. Sometimes a company's performance may be affected by external factors like shifts in consumer behavior, changes in regulations or policies, or natural disasters. All of these things can impact a company's financial health and ultimately affect the stock price. Apart from company performance, economic conditions also have a significant impact on the stock market. When the economy is doing well, with low unemployment, high consumer confidence, and strong corporate earnings, investors are more likely to be optimistic about the future and willing to invest in stocks. This can drive up stock prices across the board. On the other hand, when the economy is struggling with high unemployment, low consumer confidence, and weak corporate earnings, investors may be more hesitant to buy stocks, and the stock market may experience a decline. Economic conditions can be affected by a variety of factors, including global events like recessions or pandemics, changes in government policies, or shifts in consumer behavior. Investor sentiment is another key factor that influences the stock market. Investor sentiment is a bit harder to quantify than the other factors, but it's still an essential driver of the stock market's movements. Essentially, investor sentiment refers to how investors are feeling about the market as a whole. When investors are optimistic, they tend to be more willing to take risks, which can lead to more investment in stocks and higher stock prices. Conversely, when investors are pessimistic, they tend to be more risk-averse, which can lead to a decrease in investment and lower stock prices. Sometimes investor sentiment can be influenced by external factors like news events, changes in government policies, or natural disasters. Other times, it may be more of a gut feeling based on how investors perceive the market to be performing. If you want to get in on the stock market action, there are a few ways to do it. You can buy individual stocks in a company that you think will do well, but keep in mind that this approach requires a lot of research and can be risky since you're relying on the performance of just one company. If you're not sure which companies to invest in or don't want to take on that much risk, mutual funds might be a better option. A mutual fund is managed by a professional who invests in a diversified portfolio of stocks, bonds, or other securities. The downside is that there are management fees to consider. Another option is exchange-traded funds, ETFs. ETFs trade on an exchange like individual stocks but track a specific market index like the S&P 500 or the NASDAQ Composite. They're a good choice for diversification, low fees, and ease of trading. You can also invest in index funds, which are similar to ETFs but can be in the form of a mutual fund. Index funds track a specific market index like the S&P 500 or the Dow Jones Industrial Average and offer benefits like diversification, low fees, and ease of trading. If you're looking to save for retirement, you can use individual retirement accounts, IRAs, or 401k plans. Traditional IRAs allow you to contribute pre-tax dollars, reducing your taxable income, while Roth IRAs allow you to contribute after-tax dollars and withdraw tax-free in retirement. 401k plans are employer-sponsored retirement plans that allow you to save for retirement with tax benefits and may come with an employer match. Lastly, you can open a brokerage account, which allows you to buy and sell securities like stocks, bonds, and mutual funds. This option gives you the flexibility to manage your own investments and make your own investment decisions. And that's it for today's video on the stock market. Now you know what drives stock prices, how economic conditions affect the market, and the different ways you can participate in it as an investor. If you liked this video, give us a thumbs up and subscribe to our channel for more awesome content on personal finance and investing. And if you have any questions or comments, drop them down below. We'd love to hear from you.